which we consider two types of accounting classifications. The first is the one which we consider at the recording stage and another at the reporting stage. It's recording, that means as and when the transactions are happening, the accounting conceptions and accounting principles will be followed at the time of recording the transaction. And when a complete set of recordings is available and we need to produce a final data in the form of report, some of the principles are applicable over there. So these are the stages, these are the very much, we can say, the principles applicable at the time of recording the transactions. So business entity concept, in which we consider that a business will have separate set of accounting which has nothing to do with the individual accounting. So as a person, I am involved in the business, and if I have sole proprietorship concern, then my accounting as an individual level and my business accounting would remain the same. But whenever it's going to be a company, the directors will be working independently, the members will be working independently, and company will have a different independent set of accounting. So there is a business entity concept that accounting of a business will be done separately and which has nothing to do with the individual accounting of directors and members. Like I am holding shares of, suppose, Reliance Industries Limited. Mukesh Ambani is the promoter of Reliance Industries Limited. So Mukesh Ambani will be having independent his income and he will be paying independently income tax. Reliance Industries Limited as a company will be having different expenditures and income, and thus they will be paying, or no, this Reliance Industries will be paying separately income tax. Me as a very small, very small shareholder of Reliance Industries, having shareholding of some point one or two percentage. It's not even counted towards 1%. So I'm into some point shares, holding shares, but I am also getting certain dividends, etc., from Reliance Industries Limited. So to my income, I can show I'm holding some shares and I'm earning some dividend, and my income will be all the way independent. The second one is money measurement concept, in which we covered that everything we are supposed to convert to monetary form. We are going to record those transactions which will be considered only in terms of money. So a person is very hard working person, a person has got very good communication skills, a person is a very good team leader, a person is a very, we can say, committed to the task, won't be playing any role, as if the qualities are not playing any role in accounting. Till the time we monetize the transactions, nothing is going to enter in the accounting book. But the moment we start paying a person for his commitment, for his hardworking abilities, and for his communication skills, we are going to convert that into accounting transaction. Objective evidence concept, that means wherever any transaction is happening, to support that transaction, they require certain documentation. For example, a manufacturing industry will be receiving certain purchase order from someone as an inquiry. So to that inquiry, a manufacturing company is going to send a quotation. Then to a quotation, the another person is going to send the purchase invoice, pro forma invoice, purchase invoice. So in that case, we are going to do the manufacturing, and then we are going to go with the sales. Then appear the sales invoice. Then it is going to be the transportation challan, the GST, and along with that, the final receipt would be there. So this one transaction will be considering some of the other documentation, like the first of all inquiry to send the to that is the quotation, then the purchase order, then the final sales invoice, the LR copy of the we can say for the transportation, etc. So this is all the documentation we consider towards the evidences. Next is historical record. We are going to consider all those records which have happened with the transactions have happened in the past. The futuristic transactions, if they are visible, they are recognizable, we may consider in the accounting. Like we are supposed to pay to the creditors after 2 months of time period. So we can mention their bills payable for 2 months. But 2 years, maybe after 2 years, I'm going to pay to some person. So it's maybe the transaction which is not recognizable won't be playing any role into accounting. They are all going to consider only the transactions which have happened in the past, and it's about recording the past transactions and not the future one. The next is the cost concept. Whatever is the cost which we are going to pay for the asset, only that amount will be entered in the books of accounts. I'll give you an example. A land is available to purchase the last trans not the, the land amount was costing rupees suppose 2 crores, but due to the close relationships with the seller, and due to this friendly relationship and going good with the overall the future prospects, so the seller is allowing me to get the land at 1 crore 80 lakh rupees. That means I am getting straight away 20 lakhs of discount from that person. Look, the land is for 2 crores and I'm getting it for 1 lakh 80,000, 1 crore 80 lakhs. So in that case, the 20 lakhs won't be considering in the accounting. Whatever is the cost which have actually I paid, only that amount will be considered in the books of accounts and not the market price. So the cost price or market price, whichever is lower, will be considered in terms of the accounting. Explain the money measurement concept. So it's just concept which is we are going to monetize in terms of the money. Whenever there is any qualitative transactions, qualities won't be playing any role in accounting till the time we convert into any cash or cash equivalents. Then and then only the money measurement concept is like considered. Dual aspect concept. That means to every transaction, we are going to have two effects. The one effect is there at the debit side and another effect at the credit side. Like a simple corner transaction, you go to a grocery store and purchase something. So in that case, you are going to pay money and you are going to get goods. So two effects will be there. A cash will be out of your hand and you are going to receive goods. Look from your point of view only. Look from your own angle. A cash is been out of your pocket and you have received certain amount of these groceries items. So these two effects are always going to be there. These two effects we are providing for tallying purpose. That is, at the end of the year, when we are recording all the transactions and we need to confirm those, the second effect given to them will confirm that yes, the recordings are very well perfect. For example, I have sold goods, but to whom? So to some many buyers. Suppose to hundreds of the buyers I have sold goods. So to hundreds of those buyers, I have given the second effect that they have received all the goods and I have sold them the goods. So in that case, whenever I want to record the sales, and if I need to count that, okay, this much is my sale, that's fine. But as against this sale, have I received the amount? It's only the amount which I think that it is okay. This was a sale. Suppose my overall sale was 50 lakh rupees. But did I receive the amount of 50 lakhs? If not, then there is supposed to be certain mismatch. This 50 lakh rupees of sale must be tallied with the cash sale, that is goods sold on cash basis plus goods sold on credit basis should be equal to my total sales. And if I am not tallying with those, there happens to be certain mismatch, there happens to be certain kind of defects into the transactions. From where am I supposed to check that? So from the second effect which I have given, so I need to ask to the buyers that give me your invoices, give me your account details. So from where I'll come to know that yes, out of hundreds of buyers, 90 were recorded, 10 buyers were not recorded in my books. And there I can catch the mismatch. I can find the mismatch that 10 buyers are not considered, and that's why my accounting is going wrong. So I can verify the transactions because of the dual aspect. So this was just the explanation of what we considered at the last session. I'm going it forward. Okay. Now these are the certain concepts at the reporting stage. Now we are done with all the recordings. Throughout the year, we have recorded, assuming and considering all those principles, the earlier principles. Now this is the stage where we are supposed to report something to the based on the recordings. So in this going concern concept, going concern, that means a business should keep on going for years together, because if a business is not able to match up and it's not going to sustain for a longer period, then it becomes difficult to for certain transactions. Like the suppliers won't be supplying raw material on credit if these suppliers do not get assurance that the company will survive for a longer period. Second is the bank will not provide loan because the bank know that this company is going to stop its functions. So it is not feasible for the bank to provide loans. Then the company will be having a crash crunch, a financial crunch, because the supplier is not ready to supply the goods. Bank is not ready to pay the bank to not lend money. Investors are not ready because they don't find any interest in the company. They don't find they don't receive any returns from the company, because investors know this company is not going to last long, and thus investors are not interested. So overall there will be a difficulty in receiving the sources for the finance, and that's why going concern is becoming very important principle. Irrespective of whatever happening in the company, a company should survive. A member dies, a member transfers the shares to some other, a member sells off his shares, the owners sold the shares, then the promoter died, some other person appointed, director resigned from the company, some other director appointed. Whatever the case is, the company should survive, and that's why the company is going to have this going concern concept. That means whether your business is earning profit or it's landing into losses, it is on the verge of increasing sales or decreasing sales. Whatever the case is, accounting must go on, the show must go on. That's something is about going concern. Accounting period concept. Accounting period concept, that means the accounting year has to be followed from 1st of April to 31st of March. Exception is only for the first year, because the first year in between the year it may start. I mean, it is nowhere fixed that all the business should start from 1st of April. The incorporation date or the registration date may be in between the year. So it can be in between the year, but it will end up to the next years of 31st March. For example, the company is going to begin from 1st of January 2024. So it will be maintaining accounting from 1st January 24 till 31st March 24. And thereafter, it is going to again follow the process 1st April to 31st of March. So this is going to be accounting period concept. Matching concept, that means your debit amount and credit amount should match. This matching concept is very well suited for the double entry system, dual aspect concept. So matching principle, that means one effect given at the debit side and second effect given on the credit side, those amounts should match, those accounts should match with the transaction. This is what is required. Some reason behind commencing the account. Okay, I got a query that why is only 1st April to 31st March. It was Britishers who decided this kind of counting period, and since last almost all the years, almost last 100 200 years, we are following the same concept of 1st April to 31st March. No other reason we are following that, because the act provides for the same. Why not it's 1st January to 31st December? We don't know. This has been followed from ages, and this has been into practice now. And now all of a sudden we cannot change it to the some other period. Why is academic starting from June and July? Why is it ending on May? It has been into the practice. So a practice over a period of same practice followed, we are now bound to follow the same structure. Why not is academic year starting from 1st of January and ending on 31st of December? Don't know. So like this only. Then the next is conservatism concept. Conservatism, that means always not overestimate your losses and underestimate profits, because you always need to protect your business. You always need to safeguard a business, and that's why you should always consider that your business may earn losses. You have to be prepared for suffering the losses. But when you think or anticipate loss and you achieve the profits, it is going to be a wonderful thing for you. It is going to be a wonderful outcome for you. But think of the reverse. If you are expecting huge profit, but forget about huge profit, you have given the entirely opposite scenario that it's a huge loss for your business. Then your plans go failed, your strategies won't work out, and that's why the overestimating profit is always a bad thing for you. That's why the overestimation of losses is a good thing, is a safe protective concept. Rather than overestimating profit, you should overestimate loss and underestimate profit. Profit, if you are going to earn, that's good thing, but you are always going to think of the losses. Anticipate the loss, but if you earn profit, it's going to be a fabulous, successful, winning year for you, for your business. But if you anticipate profit, and if you earn losses, it becomes difficult to digest that kind of failure for the business. So that's conservatism principle. Next is consistency. There are few methods of accounting. You have to follow consistently the same method of accounting. There are 2-3 methods by which the accounting is done. So every year we have to follow the same concepts. Everywhere we have to be consistent with the same method, because if method do change every year, it becomes difficult to compare with respect to the last year, and thus we cannot get the progress of the business. Whether we are progressing positively or the negatively, that we won't be able to get. Full disclosure concept is the one. Full disclosure concepts are the one that means you have to disclose fully whatever the transactions are happening. You cannot simply neglect or reject some of the transactions and record only few which you feel so. You have to record all the transactions, whatever are happening. I mean, there are thousands of transactions happening in the business. You are recording 800 and 200, you are not recording intentionally. This is not done in the accounting. You have to fully disclose all those transactions. Materiality concept. Materiality, that means to a certain business, certain items become immaterial. So last time I gave example that your business is earning 400 crores of turnover. So as against 400 crores, if you are missing out certain expenditures of 400 rupees, won't matter a lot to the company. Again, example is you purchase certain stationery items. Into stationery, you are making certain expenditure towards erasers, pencils, sharpeners, staplers, punchings, the writing notepads, no, notepads, or any other another material. This all material you are clubbing together under one group stationery. Now, into stationery, you are not going to categorize each and every amount. Why? Because this is very, very immaterial for your business having so much of turnover. A fixed stationery of suppose rupees 5,000 required in a year. That's absolutely fine. When 5,000 is the amount, you are not going to bifurcate that 5,000 into 300 rupees of pencil, 200 rupees on erasers, 300 rupees on staplers, again 400 rupees on notepads. This particular differentiation you are not going to make. You are all going to club those into the stationery of 5,000 rupees. Now, to your 600, 700 crores of business, having 5,000 rupees on stationery is a negligible amount. And that's why into that 5,000 rupees, 300 rupees paid on station on certain pencils is very, very immaterial for the business. So that depends upon materiality concept is what is material for you and what is immaterial for you. Next, we consider, but this is all the concepts considered in detail. You can go through the same when I upload those on LMS. Full disclosure, that means all disclosures to be made. You cannot neglect one or two more transactions. Materiality is what is material for your business to record. What is not material, you have to consider. Those which are very well practicable examples I try to provide you. Consistency is the same consistency you have to maintain. Full disclosures I explained and materiality I explained. Now this is double entry system. So double entry system is, as I mentioned, two entries will be mentioned in the accounting. Now we are going to start with the next subpart of the first unit. Till the time it was conventions and concepts which I cleared. Now the double entry system which we are going to start, a second part of your first chapter. So double entry system in which two effects to be given. This is the accounting cycle. I'm just mentioning, note down the points, note down the stages. Accounting cycle, that means the very first is you are going to analyze the transactions. So analyzing the transaction becomes your first step. Second step is going to be you are journalizing the transactions. Journal, it's Journal. Journalizing the transaction becomes your second stage. The third stage becomes based on the journal entry, you are going to make the ledger accounts. Ledger, it's Ledger, ledger. So I'm just mentioning those to you. The first step is analyzing the transactions. Analyzing the transactions. The second step is the journal entry. The third step is going to be the ledger posting. The fourth stage is going to be preparation of trial balance. The fifth stage, which we are going to consider, is the financial statements, which we are preparing. That means the P&L account, profit and loss account, and balance sheet. The next step after financial statements we consider is the cash flow statement, and the seventh we consider is the fund flow statement. So the first is the dual effect of the transactions. You have to analyze the transaction. That becomes your first stage. The second stage becomes recording the transactions into journal. That's a journal entry which you are going to do. Then you are supposed to do the postings. So you are going to post those to the ledger accounts. Next is the balancing the ledger accounts, taking the total and then taking the balances. And after balances, you are supposed to prepare the trial balance in the summary form. And after trial balance with certain adjustments, you are going to finalize the accounts, that is financial statements you are going to prepare. This is all we consider about the double entry system. So after this financial statement, there is P&L account and balance sheets. We are supposed to consider cash flow statement and fund flow statement as well. Now I'll move on. Yeah, this is the difference between the financial accounting and management accounting. Let's go with the points one by one. First of all is users of report. Who is going to use those reports? Financial accounting is mandatory accounting, which is considered by the government, income tax authorities, and other governing authorities, and that's why financial accounting needs to be maintained by every company compulsorily for accounting period. So all the stakeholders like the shareholders, creditors, government, bankers, suppliers, customers, competitors, all are going to see this financial accounting. It's a mandatory disclosure to be made by the company to all the stakeholders. As against that, management accounting is for the internal purpose. The management is going to take certain decisions, plan certain strategies, decide certain goals and objectives, then designing the budget for the next year. These all actions are considered by the management, official persons, the board of directors, top managers, maybe departmental heads, and employees. So these all are going to consider the management accounting. Designing the budget for a respective department, maybe sales department will be having certain fixed budget for the next year. So these budget they are going to decide based on the performance, and that's something called as the management accounting. In the report, what kind of reports are going to be there? So for the financial accounting, the fixed pattern is the profit and loss account, balance sheet, cash flow statement, and fund flow statement. These are four important statements which we are going to prepare into financial accounting. In the management accounting, there are going to be certain reports, cash reports, budget reports, which we are not the cost sheets, which we are going to prepare. Those are for the internal discussion decision, which we are not going to show to any authorities outside. We are not going to show this to these stakeholders outside. This is for the internal decision purpose. Next is frequency of reports. Depends upon the financial, what you can say, obligations. For the for considering the final accounting, it is mandatory for the listed company to go with to declare the quarterly results, and also to submit the annual returns, annual statements to the government, to the official authorities, to the income tax department, etc. So the first quarter which we consider is the April, May, June. Accounting year starts from April. So April, May, June, these 3 months become the first quarter. July, August, September, that's the second quarter. October, November, December becomes the third quarter. January, February, March becomes the fourth quarter. I'll repeat. April, May, June, first quarter. July, August, September, second quarter. October, November, December, third quarter. January, February, and March becomes the fourth quarter. So for every quarter end, we are supposed to prepare the financial results, financial certain reporting, and that has to be disclosed. Now, since this is the second quarter ongoing, that is from July till 31st of September, 30th of September. So we are at the end of the second quarter now. Check in the month of October, okay? Probably after 10th of October, you will find that lot many of the listed companies are declaring their quarterly results in the paper, in the newspaper, because that's a mandatory requirement for them to disclose the quarterly results in the newspapers. Check the Financial Express or no, the Economic Times, etc. There you will find, certainly you will find the quarterly reports are getting declared in even into the local newspapers like maybe Lok Satta, Sakar, Maharashtra Times, Lokmat. You will find these Times of India. You will find these balance sheets getting declared. So these are all the we can say juridical or legal requirements to disclose reports. And for the management report, it is as and when recorded. That means a board of directors are going to meet next week, and they want to know the progress of the company so far up to suppose 15th of September. It's very odd, no? From last 1 month, say from 15th of August to 15th of September, what was the scenario of the company? What was the position of the company? A board of directors are going to meet next week, and they want that kind of discussion to happen regarding the company's overall turnover. So we are going to present a report for just 1 month. It can be odd month for 15th August to 15th September, or maybe 28th of August till 16th of September, whatever the data is. So it's as and when required, whatever required, we are going to present the data that is into the management accounting. Purpose of report is for the external uses for the financial accounting. Management accounting is done for the internal purposes to decide certain plans, strategies, budgets, decisions, etc. The focus of the report is again, it's going to follow certain specific method, accounting certain formats are going to be followed in financial accounting. Management accounting may have, according to the suitability of the company, the way the department wants to present, the way it is very well convenient and readable and understandable for the management, it can prepare the management accounting in such a manner. Next is nature of reports. It's into the monetary form. So monetary admins, those we are going to follow the money measurement concepts. Only those will be having place into financial accounting. Into management accounting, we are going to consider the qualitative aspect. That means we have improved in terms of quality. We have increased the stake. We have increased the stake and So we increased the stake, market stake. Now it has been from 35% to 52%. That kind of qualitative impact which we can achieve because of excessive our efforts. Those all efforts can be seen into management reporting. Those can be clearly mentioned in the management report that yes, we have given training to the marketing people. We have done lot much of advertisement. We have found a new advertising agency which have done a very good role. We changed the brand ambassador and which is impacting our good our product getting sold heavily in the market. These kind of statements could be there into management accounting, but this is not going to reflect into the financial accounting. Next is verification. Here, financial accounting will be verified by chartered accountants in India. Chartered accountants, we need to have them audited. So auditing will be done by the chartered accountants. Management accounting does not require any kind of auditing as such. The internal auditor, the internal finance manager can very well take care of the management accounting. I'll go to next phase. This is just a difference between cost accounting. Now, cost accounting is just added on. Cost is where we are supposed to consider less of the cost so that we can very well achieve the profit margin, because sales price may or may not be in the hands of the company. And that's why cost accounting talking about only of the cost aspect. The cost or the expenditure is going to be now going to low down because we have to take care of the profitability. So these differences between the financial accounting, cost accounting, and management accounting. I'll move on next. As I've just rushed through this slide fast because this is not going to be part of your accounting. That is again summarizing, recording, classifying the transactions. Now we are going to go with the important part of classification of accounts. I want you. So this personal account, which is bifurcated into three parts, quickly take a screenshot or maybe you can, yeah. Personal account, which is divided into three subparts. Natural person, like you and me, our own account will be there. We call it as the personal account. Artificial person, that means any municipal corporation, any kind of company, any banking organization, any other NGO or any other no, please govern university, etc. Any shop, grocery store, anything, we can consider those into the artificial person. Representative personal, that means certain expenditures which are prepaid, certain expenditures which have been outstanding, those all things we are going to consider into the representative personal account. Quickly note down these points, like living being, then this is going to be into natural person account. Artificial person, that means any artificial, any business as an entity will be coming under artificial person. And a representative personal, that means when something is outstanding, something which we represent, that means salaries are not paid to certain categories of employees, then we are mentioning those employees under the personal accounting, representative personal. So outstanding expenses, prepaid expenses, those things we are going to consider into the personal, representative personal account. Next slide. Yeah, please note down this very well, very important slide. Impersonal account, which we classify into real and nominal. Real account is getting subclassified as real tangible, like the one assets which we can touch, feel, see, and real intangible, which we cannot see, feel, touch, though, but those are going to be part of the business, like the intellectual property rights. Note down these slide now. No more queries regarding the slide. Let me first explain. So impersonal account, which is considered into real account and nominal account. This real account, that means all those assets like which we can see, feel, touch for the businesses, which we consider as important asset for the business, like the machineries, computer, vehicle, furniture, cash. These are all going to be the real accounts. And into that tangible, that means those assets which we can see, which we can utilize, which we can sell off, etc. That is furniture, machinery, then car, etc. Or cash, which we can see, feel, touch, sell off, transfer. The next is real intangible, like the goodwill, patents, copyright, trademark. Those are all considered to be the real intangible. We don't find goodwill anywhere. We can't see, feel, touch goodwill. But goodwill is something which is earned over a period of time due to the business and business entity carrying on a business, achieving certain recognition and reputation, a legacy of successful business, and that's why it will be having goodwill. Certain business which were commenced 10 years before were not having any goodwill because they were just began that time. After 10 years, I mean over a period of 10 years, the business have achieved enough of the customers, suppliers have got good recognition in the market. So the business is well known, then that means it has achieved goodwill. Whenever a business is involved into any kind of frauds, any kind of defaults, any kind of judicial cases, a reputation goes down. That means a goodwill amount goes down. So this is because of the successful legacy, the business ethics which followed, the goodwill amount is going to get increased. This is considered to be our asset. Having good goodwill, having good reputation in the business, in the market, having good recognition in the market is considered to be your asset. That's a real intangible. Moving on to nominal account. Nominal account is bifurcated into expenditures and losses under one part, income and gains under another part. Expenditures, that means for an organization, there can be n number of expenditures like the printing, stationery, telephone expenditures, then the transportation expenditures, electricity, light, another is insurance, rent, salaries, wages, then all of the legal fees, audit fees, discount allowed to the customers, etc. These kind of so many of the expenditures, any loss happened on sale of asset could be there, or because the business has made all the purchases of raw material, it is going to spend lot much of money. Those all are things considered to be under the expenditures. As exactly opposite to that, there are going to be lot much of incomes to the business, like the commission received, rent received, interest received, any sale of asset, and then the profit received on sale, sales made, this goods sold in the market by which we are going to get income. So that's going to be the sales. Then these are all considered to be the income and gains. Now there is another important slide which talks about the debit and credit rule. That's going to be your next slide, which is again very important. This debit and credit side. Debit, that means left hand side. Credit, that means the right hand side. Please do not resemble these concepts with the debit card and credit card. It has nothing to do with this debit card, credit card provided by the banks. This debit and credit is purely accounting concept. Do not make any kind of coincidence of the same with this debit card and credit card concept. Okay, this is the most important slide of the today's session. Golden rules. Note down this slide. Note down these all details. Very careful. It's DR, that is debit, and CR, that means it's a credit.